Welcome to New Home Insights, the podcast from John Burns Research Consulting. I'm your host, Dean Worley. If you want to follow market trends, demographics, capital, new ideas, and endeavors that touch on housing, we're going to try to make sense of that every couple of weeks. Let's go. Hello, everyone. This is Dean Worley for the New Home Insights podcast. Today, we're going to focus not only on, but mainly on the rental market space, specifically the single-family rental market space. But we're going to do that through the eyes of an investor in that space. We're also going to take some forays into build to rent, some for sale residential, and spend actually a pretty significant amount of time on on-site or off-site construction as well. And maybe if we have time, talk a little bit about data and how a data-driven company lets data impact their decisions. So that's a pretty diverse set of topics. Luckily, we have a pretty diverse guest today, and that is Sean Dobson, the CEO and CIO of Amherst. Amherst is a real estate investor, developer, and operator based in the great state of Texas. Sean, how are you doing right now?
I'm doing great. It's great to be here.
So maybe not everyone listening has heard of Amherst. So I want to get to that. I want to get to what Amherst does and what Amherst is. Before that, though, you have a pretty amazing history and a backstory to Sean Dobson that I think I want to share that with the listeners. So if you can, let's start with that journey to getting to Amherst. And maybe if you want, we can start with wherever you want to start with, but I definitely want to talk about the rip-roaring days of the GFC in the late 2000s.
Well, it's always fun to talk about. I like to say that I'll never stop running victory laps over one good trade that we did. No, it's now 17 years ago, but it does tie to exactly where we are today, where we focus today. Just a little bit of background maybe helps is that Amherst is a financial services platform. We provide services to the largest, maybe 400 or 500 customers, investors in the world. Which means that we're focusing on pension funds, endowments, foundations, sovereign wealth funds, the global life companies, that sort of thing. We don't currently offer any investment products or services to individual investors. So it's institutional investors only, large investors. And our specialty has always been, oddly enough, single family detached housing related. I spent the bulk of my career in the mortgage market, walking out of high school into truly a temp job at a brokerage firm that focused on mortgage-backed securities in, I hate to say how old I am, but in 1987. So I was about 18 years old, 19 years old. And at that point, it was very fortuitous for me because at that point in time, the mortgage-backed securities market was a little bit of a backwater market, kind of analogous to the municipal bond market, where there were these specialist firms that focused on it, but the trading volume was very light. And the analytical infrastructure really hadn't been built yet. So my career starts really with the mortgage market becoming liquid and the product development around a single mortgage becoming something that's traded on the global capital markets. And now it's extremely sophisticated, extremely liquid. There's all sorts of structured products that are backed by mortgages. And having that deep understanding of the mortgage market and growing up with it put us in a unique position in 2005 to figure out that the capital markets weren't really pricing mortgage credit risk appropriately. And it's sort of simple to think about it, but before we got involved, people thought about the credit risk of a mortgage-backed security sort of like an actuarial risk, meaning like if you're going to forecast the mortality of a population of people, you look back through time and say, what has it been historically? And maybe there's some small changes, but it doesn't move that much.
Okay.
So that's how they thought about credit risk in mortgages. And what they were missing was that there's a high sensitivity to home prices or high correlation to home prices and default risk. Anyway, so we're a quant analytics firm that's focused on real estate. And we figured this out. We figured out that really you needed to think about how home prices changed and how that affected the consumer's ability and willingness to pay. To think about the risk the credit risk in a mortgage-backed security. So we built these models in 2004, 2005, because at the time, the mortgage market was bifurcating into a mortgage market that was predominantly guaranteed mortgages, so investors didn't have to think about credit risk, into a market where the mortgages were not guaranteed, therefore investors had to think about credit risk. You went from in a few years, you went from something like a 10% market share of investors taking a credit risk to like a 35 or 40% market share. And when I say, these are $1 trillion markets, right? So it's just a significant amount of credit risk is being taken by the markets without sort of a real quantitative approach to that credit risk. So we built all the models. We figured out that a bunch of we didn't figure out that the financial crisis was going to happen.
Okay. This is 04, 05. So this at the time when prices are going nuts across the country.
Yeah, home prices were up. Mortgage performance was incredible. Credit losses were zero. And we had concluded that so long as home prices kept going up, it doesn't really matter who you lend to. If they have a profit home, they're not going to default on the loan.
Yeah.
But when we studied the data and we found historical periods of time when home prices were flat or had gone down in subsets of the U.S., and we were able to get all the performance data for almost every mortgage that's ever been originated, you could see that the more sort of creative the financing was, the higher the beta of that loan was to home prices. In essence, there were some loans that only performed because the home price went up. They were so dangerously structured in terms of how much of the borrower's income had been pledged to the mortgage, or how much research was done on the borrower, or was it a teaser payment or other things to kind of hold the ship together until the home price went up and then miraculously the loan prepaid.
This was, Sean, during that period where they were writing some mortgages that were, remember, stated income, balloon payments. I mean, I'll say this. It seems like the best ideas, the most genius ideas are the ones that when someone has that idea and acts on it, they say, oh, I should have thought of that. This sounds like one of those, but you were the one who thought of it and acted on it.
Yeah, we probably overthought it, to tell you the truth. But we figured out, okay, there's a risk of default. The risk of default isn't an actuarial risk. It's a consumer behavioral risk.
Okay.
And the behavior of the consumer will change when the economic conditions around them change. And we should be able to model it. So we have a big modeling department, a lot of data, a lot of analytics, and that's how we priced the prepayment risk in mortgages. And we really just retooled all the same models to price the default risk, thinking it was going to be like a little small side project, get it done and go back to sort of advising our investors, our clients on how to price this risk. And then what we discovered was that a lot of it was really, really mispriced. So we're one of the teams that set up that we kind of went across our customer base saying, hey, hold on here. Like, I know that at the time, yield spreads were very tight. So people were reaching for yield. And we're like, okay, we know that everyone's pressed to find return, but on a risk adjusted basis, a bunch of these securities are, really not worth buying. And maybe in some cases, maybe we're short.
And this was 04, 05 still or around that?
So in 2005, there was the bond market gets together and has a convention just like a building supply business does. And literally investment bankers and lawyers rent out booths and stand behind them and hand out business cards and tchotchkes, just like they were a group of dentists. And we do it every year, a couple times a year. And in the 2000, everyone sort of gives out something, right? A keychain or something. Yeah. So in 2005, we gave out were hard hats.
Okay.
And then blazoned on the hard hat was beware of falling home prices.
Oh.
We picked it up early. We established a bunch of positions that were sort of effectively short positions in housing or short positions in credit risk or long positions in volatility, not because we had a directional bet, but because they were just extraordinarily undervalued options on tail risk, on something bad happening. And then I think one of the most interesting things about the whole event and how it ties back to SFR, by the way, is that by the time we get to the first quarter of 2006, it was completely over. Like the financial crisis had happened, the mortgages were going to default, home prices had flattened out. People were missing the third payment on new mortgages. It was literally over. And people think about the financial crisis happening in 2008. Well, That was like, it was over in Q1 2006.
Yeah. I remember that the first market I remember was in California. It was actually the Sacramento market was late 2005. And then they started coming like dominoes with your stronger core markets, like say the Bay Area, being at the end, but you did see all these markets start to say, okay, yeah, things are different now. And we realized that. But Sean, be honest, you still had a lot of folks who were saying, no, it's going to be a soft landing. And you knew that was not going to happen.
Yeah, well, the famous Ben Bernanke speech of it's contained to subprime, or it's a small sector of the ABS market. So anyway, our investor base at the time sort of fell into three buckets. They were the ones that were in denial. The ones that just got out of the way because this is confusing and it wasn't worth finding out if Amherst was right or not. And the ones that were like, wow, if you're right. I remember this one client, this big global macro hedge fund manager, looked at me and he says, I don't know what all that means, but it doesn't sound very good. and so he made several $1 billion on the short position.
Because he trusted us.
Well, he's the kind of guy that can smell money. Figured out that the market wasn't, he thought that we might be right. But anyway, so if you kind of fast forward, we love to, like I said, I love to talk about that because it was a historic event. But it led us on a crazy, from a firm's perspective, it led us on a crazy roller coaster ride. Because at the time, our firm was our business model was a broker dealer in securities. So we actually generated revenue buying and selling the securities that were the product of our research. And we competed against the biggest houses in the markets as a market maker, underwriter, placement agent in the securities themselves. So it was a little bit like your business where it's a lot of research driven, a lot of advisory business. But at the end of the day, most of our advice resulted in a portfolio positioning something and we would get paid as a broker or a dealer or something in that trade. So that was the business model up until we sat down and sort of from 2006 or 2005 to 2010, everyone kind of knows the story. And there were the securities market collapsed, and then there were securities that were mispriced on the low side, and we had all the tools and infrastructure. So at the time we built, and this is what drives our SFR engine today, we built a tool that prices every loan in the country in real time, produces a cash flow forecast, which is about 45 million loans in the world, produces a cash flow forecast for those loans. And the cash flows are a function of the home price change we expect in that home. And then, of course, that all gets sort of pushed up into there was about 1 million different bonds that are backed by mortgages. And as a market maker in the bonds, you had to be available on the bonds are still traded over the phone. Someone calls up and says, I want to sell bond ABC. You have to give them a price right then. You can't say, well, let me go dig in my files and figure out what I think it's worth. It's like, so we built a live system for the 45 million loans and the 1 million securities so that we can provide price information pretty quickly for those investors. And that is the thing that underpins how we invest in single family rental, because we just took it a level lower and now we live price all 95 million homes in the country in real time.
But you started that, you started getting those properties or those vehicles, I imagine, for pennies on the dollar at a pretty early stage.
Yeah, so we spent a lot of time in DC. I actually moved to DC in 2009 because this problem was far larger than we ever expected, right? So we didn't know that our view or our research was actually as unique as it turned out to be. We kind of thought, well, there's a lot of people, way more, significantly more resources, way smarter, and we might be like the 50th person to figure out this puzzle, not maybe the 5th or whatever. So once we started realizing that the banks were full of the risk themselves, that there was a confidence issue into solvency of everyone, we got some interesting phone calls because I had gone on a little tour in 2006. We've always supported regulators, and I had gone on a little tour in 2006 saying, guys, like there's a problem over here, right? Yeah. Like the capital reserves for this stuff probably aren't right. So by 2007, or 2008, they were like, who are those crazy people from Texas? Get them back in here. So I spent a lot of time. Yeah.
They warned us 2 years ago.
Well, they maybe they got lucky, but they totally had a view. So by 2008, 7, 8, 9, I'm spending a lot of time in Washington, D.C. So I had access. It was really fun because I got to go into the White House and brief people. I got to go into Treasury. I got to go into the Federal Reserve. And sort of share our views on things. And so we were the ones that produced the first article that said that Freddie Mac and Fannie Mae would need over $200 billion of capital. They were expecting they'd need like 15 or 20 billion.
Okay.
So that created this really interesting cycle of not just investing in distressed securities, but being in some pretty fascinating meetings about what the federal policy response should be. And one of those was we had a handshake with Fannie Mae to sell us 50,000 homes in one trade. And the reason that we thought that this was one of the things we tried to point out to the market was that the dodgy mortgages blowing up was like a 3 million unit problem, right? The problem is if you drive home prices low enough, right? So think about it from a credit score perspective. If someone has a 550 FICO score, right, and their home goes underwater by 10%, if they default, their credit score doesn't go down. It's already as low as it can go. So if you think about it as the option to default or the opportunity to default, the friction is your access to credit going forward. Well, if you already don't have access to credit, there's a very low friction. If you have a 750 FICO score, and this is our thesis, and it's controversial because it starts to be a morality question. But our thesis was that a 750 FICO score, there is a number where you will default. If your mortgage is $400,000 and your house is $400, you're going to default. So FICO score has value in terms of default risk, but home price and mark-to-market LTV has a really important interplay.
But it really is these moving parts, isn't it? It's a combination of trying to predict that individual going to default or not is a combination of what their FICO is, and also the old proverbial skin in the game, how much they have to actually lose, and they're forward-looking. But the one that you can't really measure is, of course, just their own internal morality of whether they, I'm just going to pay with my last dime, kind of. But you can still quantify the bulk of it.
But like when you line it up, like the morality piece is interesting. But like, is it moral or immoral to throw good money after bad is kind of a fair question, right?
Yeah, you're right.
So like at some point you're supposed to default. Like there's no better president of the United States, and this might be controversial, but at some point you're supposed to default. It might not be when your house is worth $200,000 and your loan is worth $300,000, but at some points, I lived in Houston when home prices went down 60%. Entire neighborhoods defaulted, and the people just moved across the highway into a new neighborhood. And they reset their home bases by 50% or something. So at some point, people are they're not going to continue to throw good money after that.
It always did seem one-sided, that whole, that morality of it, the so-called moral hazard, because if the banks, if you're not making your payments, the bank's going to default on you. So in a sense, you're just kind of flipping that switch that at some point.
It's the deal. Like the deal isn't that I'll go to prison if I don't pay my mortgage. Right? The deal is I'll lose access to credit.
Yeah.
And I'll lose my house. So at some point they're like, okay, done. You access to credit, don't need it. House, don't need it, because I'm just too far behind.
I was going to ask, were these policymakers accepting of what you had to say? Were they open?
Well, people didn't want to believe it.
Yeah.
Because it just sounds bad. And I would say that like the vast majority of Americans do everything they can to pay their bills, right? It's why the economy works. Like the trust in the economy is not measured, but it's why it works. Have you ever seen like the credit card collections? Like if you don't pay your credit card, you get to keep the stuff, right? I mean, like whatever. But like 94% of people pay their credit cards.
Yeah.
So people have a high willingness and desire to perform. But at some point, the economic incentives are just so far backwards that they're going to default. And so when we got to 2008 or 9, what we're telling people is like there's this crazy thing in the U.S. housing market that the last sale is the thing that drives your appraisal, right? So think of the U.S. These days, only like 3 or 4% of the housing stock trades in a given year. But we use those sales to price the other 97%.
Yeah.
So what we were trying to say is that we don't really care what you do with the houses, but for God's sake, stop selling them. Because every time you sell one, you lower the appraisals for all the guys around them. And home prices had gotten so low that you were starting to produce underwater mortgages in Freddie Mac and Fannie Mae's and FHA portfolio. Like even the 70 LTV mortgages that were made to medium to high FICO score borrowers were starting to become super dangerous because the home prices were so low. So we're like, guys, it's kind of if the tree falls in the woods and there was no one there to hear it. It's like if the house price goes down, but no one sells one, did it go down? Right? Just stop. And we also said, by the way, all those people who defaulted their mortgages and got foreclosed upon and got kicked out of the house, they need some place to live.
Yeah.
Right. So like let's solve this is the old 2 birds, 1 stone. Like sell me the houses, I'll rent them. The market stops seeing this backlog of inventory. You stop printing homes down in price, and people have a place to live, and we'll get things stabilized. And everyone got it. And I went around and around and around, and everyone was nervous because it was 50,000 homes. It was to some fat Texan, and it was like it was going to be some, private equity takes over the world story. And in the end, it didn't get done. In the end, there was enough nervousness over the narrative that what we won was an argument to modify mortgages and stop foreclosing.
Yeah.
And we lost the argument. What kind of modification, by the way? Like the modification where they deferred the interest and all that stuff wasn't what we thought was the best idea. We thought you should just forgive principal and solve the problem. But anyway, so that's where the modifications came from, was all this thing of like, let's time out, stop selling homes because you're starting to carve into like the fat part of the mortgage market.
Yeah. The meat.
The meat of it. And you're creating what could have been 19, 32, right?
So, but you were able to use this period to build your initial SFR platform?
Yeah. So, yeah, we kind of sat down in 2009 and 2010 maybe. We were pretty tired because this had gone from like bond prices are too high to bond prices are too low to the investors that had exposures. We were buying stocks and there was just a lot of stuff going on because people didn't really know where this train was going to stop, right? I remember like AIG was almost to zero. Mm-hmm. The Freddie Mac Fannie Mae preferreds were trading for literally 25 cents, like 0.25. So there was pandemonium in anything that was single family housing related. And it created just a massive amount of opportunity for us to go in and kind of sort out the baby from the bathwater, if you will. So when we sat down in 2010, we're like, for our investors who are long-term thinkers, they want to invest on long cycles. It's interesting if I come to them and I say, like, these two doodads are mispriced. But when you're a global life insurance company, it's not going to matter, right? Unless those doodads are tens of billions of dollars and they're going to be multiple years of value creation. Yeah, when you're one of these big investors, it's a huge problem to find big, long, cyclical good ideas.
Yeah.
So that's what Amherst tries to do. So we sat down and we said, okay, what's next, right? And what we decided was next is what we're doing today. So that was Now, I can't believe it. It was 15 years ago. And what we said was something that, in retrospect, I think is pretty obvious. We said the subprime mortgage market is dead. Investors lost, I think, $2 trillion. Regulators blamed everybody. They created the Dodd-Frank law that made it illegal to lend to subprime borrowers. In effect, they made it illegal to risk-based price mortgages. So we said, okay, what's a world without before that? Different risks from a consumer credit perspective traded at different prices, right? So it wasn't a question of can you get a mortgage for the most part. It was what's the price of the mortgage.
Okay.
Post Dodd-Frank, the answer was you people above this bar can get a mortgage. Everyone below this bar can't. And that's the world we live in today, is that you can't go pay an extra 1% or 2% or 3% to mitigate your credit risk profile if you're a borrower. You just get told no. Okay. So the mortgage denial rates have been high. You can see it in the data that there's a huge chunk of the customer base. And so roll back to 2010 and think about all the people who had low kind of impaired credit scores because of the financial crisis. 7 million people defaulted on their mortgages. So they weren't candidates to get a new mortgage, even in a world where subprime existed, but they certainly weren't a candidate to get a mortgage in a world where the bar to mortgage access had been raised so high. So we said, okay, so what's going to happen, and what is the big, long value add investment opportunity here? And we decided it was single family rental, which sounds simple, but
you saw this potential market that was 7 million strong that was almost pushed into the single family rental because they gotta
live somewhere.
Yeah. And they were likely, they owned a home, so they're more family in terms of their demographics of them. They weren't obvious apartment dwellers. So single family, I know it seems so simple now, like I said a few minutes ago, but at the time it was not simple. And there were a lot of naysayers about single family back in 2000.
Yeah, I think there were a few misconceptions we dealt with. One was actually the house. So I'm a Texan. I'm a small government person by sort of, instinct. But I can tell you that the local governments have a very, very important role in housing because they keep America from building dodgy homes, right? Okay. The house that is built in the United States is a quality product by regulation. There are corners that I would like to not see cut, but they're not the kind of corners that are going to make a house fall down when it rains.
Yeah.
Right?
Okay.
So people, when these homes went, down in price, they kind of thought, oh my goodness, these are all sort of hovels. And of course, we realized that there's a whole bunch of those homes that are less than 5 years old. They're wonderful homes, right? The other thing was that they said, well, you really can't manage these things, that you can't provide good resident service. You can't really administer a house with all of its monthly bills because it's such a small investment. And the way we look at our world is that we own 50,000 houses. So when I'm at cocktail parties, I tell people about our tens of billions we have in real estate, but that's really not the case. Really, the case is that we manage 50,000 small businesses, and each business has about $25,000 in revenue and about $10,000 of expenses. And when you're managing a business that size, you have to really be careful. So in 2010, people would say, well, managing a house is going to be too difficult if they're not all together. Like the instinct was, if the apartments are all clumped together, then I have a property manager, a leasing manager, a repair and maintenance manager, and blah, 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 and I can sort of serve all my residents. And so we were like, well, there's already 14 million single family homes rented in the world, so they're being managed somehow. Yeah. And by the way, for like $5 at the time, $5, I could call somebody, have them custom make me a pizza and drive it to my house. And if they didn't get it there in 30 minutes, I didn't have to pay the $5. So I'm like, getting people to the home can't really be the problem, right? That can't really be the hurdle that makes it hard to manage these homes. So let's figure it out. So the way we do biz dev at Amherst is that and we'll talk about it when we get to like the module build, is that we don't expose our investors to this sort of adventurous field laboratory experiments. So we did a lab experiment in Phoenix. We bought 100 houses. We scripted out point A, point B, point C on the path from pre-purchase inspection through renovation through property management. And after we got to like 60 or 70 homes, we stopped learning things. We're like, okay, this is not that complicated, right? It's a single story home. It doesn't have that many moving parts. And there's not that many things you have to check. I mean, this isn't rocket science, right? So after that, we kind of got them run for about a year. And we went to our investors and said, okay, we think we figured it out. Well, let's go from $10 million to that first pool of capital was $600 million. So like, let's get $600 million of these things and see how it goes. So that's how we started. And we tried a bunch of things, Dean. We tried, I had 5 preferred property managers in Atlanta. My original business plan to my partners, by the way, was to have 26 employees managing 50,000 homes. So I think at our peak, we were like 2,400 employees. But the thesis is still the same. The thesis is it's too hard to get a mortgage in America. Families need a place to live. Housing is a consumer product, just like an iPhone. And there's not one consumer product that fits every consumer. There's not one version of housing that fits every consumer. So you pointed out before. So at some point, people need the suburban product. And it's not just the home and the space and the parking garage and the yard. It's the proximity to work. It's the proximity to schools. It's the fact that 911 shows when you call. It's the fact that Domino's delivers. It's the combination of community that develops a housing product. And people are going to need that no matter what the mortgage market wants to finance it or not. So we figured out that the issue would be then, how do you take a business like we described, a $24,000 revenue business with $14,000 of profit margin, gross profit margin, and scale up the equity investment in that? So think about if you finance these with 60 or 70% mortgages, right? You're talking about a business that maybe has a $350,000 enterprise value in today's terms, but it's still only less than $100,000 check to own the whole business. So we thought, having grown up with the mortgage market, we sort of thought we knew how this movie would end, which is we would make the equity just as liquid as we had helped make it. Oh. And so we've never viewed this as the same thing that other people. So people kind of make this fit into the private equity world, the real estate private equity world, and the real estate kind of what we call the wedding cake of service providers in private equity real estate. That looks very different than the mortgage market. And we think that in the end, this will look more like the mortgage market where a pool of homes will trade pretty liquidly, you could call it like a private REIT, among sophisticated investors who understand that these cash flows are very valuable, the assets are very valuable, providing the service to the customers is very valuable. But it won't necessarily need to be as illiquid as the rest of the real estate market because it's such an important part of the ecosystem.
Are you how are you tapping into that equity that they represent?
Yeah, so think about Amherst, think about what we built in single family rental as a platform. The house goes on the platform. It's available to lease for a family that wants to live there, right? It's available for an investor to invest in the AAA ABS, right? The AAA securitization, the triple B securitization, the single B securitization, or the equity itself. And that house may never leave our platform, right? Okay. Like an investor might want to sell the equity or whatever, but it doesn't really need to leave the Amherst platform to become liquid.
Okay.
And so that happens. So if investor A wants to sell, one of our other investors will likely come in and buy that pool of homes, and the houses, the market never sees the trade.
Do you think you would have been able to do this if you had more short-term oriented investors back in Amherst?
No, because the when we first started to capitalize the business, there were three pools of capital. Well, there were three risks that we needed to fund. One of them was, who wants to own this portfolio of fully stabilized, we call stabilized, but fully renovated, fully vetted residents, up and managed by us. So that's like the least risky thing to own. But at the time, housing was a 4-letter word, right? Yeah. Then there was like, who wants to go try to make that pool, which means go buy one house. Hopefully you go buy another one. And then maybe you can do that in 20 cities. And maybe there'll be, maybe your cost basis will be close to what you thought it was going to be because the repairs take time and cost money. Maybe the rents will be what you think they were going to be before you bought the home, but there's an error rate in that. Maybe the taxes will be what you thought they were. And so there's this development risk. Not so much development as to start with a piece of ground and build a building on it, but start with one house and build a pool, right? And that's a business in the mortgage market. Someone does that. Someone goes and buys one mortgage on Monday, another one on Tuesday, and creates a pool, and the pool trades for more than the sum of its parts, right? So that was the second business that had to be capitalized. The third business was, what the heck should you charge, and can you make money at the market rates for acquisition, construction management, leasing, property management, and for us, property administration and finance. So our investors can manage $1 billion investment in real estate with one person. We do everything else, right? So without Amherst and its scale, no one would have ever taken that risk of the operating company. So we did that completely spec'd on our own. They're like, well, this is such a needed service. Eventually we'll figure out how to make money at it. So we just dove off into it. Now, had we also not had the support of institutional investors who've been with us for 20, 25 years, we would have never gotten the $600 million for the very first fund, right? So they knew that, well, these crazy people have been right before. Yeah. And of course, a lot of them had done really, really well. And they were like, all right, well, if you think so, you know. And by the way, that $600 million pool of capital was like 3 people. It wasn't like a large group of people. So I think that vector that we were on and our infrastructure is what allowed us to do it.
So let's fast forward to today, 2025. That is effectively you've kind of just described your SFR platform effectively. Is that fair?
Yeah, exactly. Yeah, we view it as a platform. It's a little bit more like a bullion bank than it is a private equity firm, meaning that, you know, if you want gold to be liquid, you check it into the bullion bank. They assay it, they measure it, they stamp it, they put it on a shelf in the bullion bank, and now you can trade around your rights to that brick. That's really what we built. Right. And not many people know that. They think of us as like a private equity firm, whatever, but that's not really we have, we're the largest investor in our portfolio. Yeah. We have investment management services we provide to other investors. For some investors, so we have a lot of professional investors that we're partners with, other managers that have multi-strat funds and things. So we provide them like a real estate operator type relationship. We provide all of our own finance because we have a fixed income background. So we do all of our own securitizations. And then we provide all of those what I would call traditionally those vendor services of, as you know, from construction management, even real estate design, all the way out to administration, where we're paying the property taxes and we're paying the HOA and we're dealing with the fine for someone that didn't put their garbage can away on time.
So their gold bar is a house, but with what you're doing, I mean, you have to keep that gold safe. That company has to spend money to keep that gold safe, but you have you just described multiple different things you have to chase down and maintain. Exactly. That's a little more complicated, isn't it?
The bullion bank probably just has to have big security guards. We have to have a lot of moving parts, but that's what we built, and it's kind of fun. Like, we're business operators we have been for a long time. Yeah. So I think now, knock on wood, we've made most of the mistakes that you can make, and we kind of figured out how to do it. And so we get 1 million phone calls a year. We run 250,000 service calls out to our residents in a given year. We're still acquiring. I think last year we were the largest acquirer of homes in the country. So we're still growing, but our goal is for that home to serve that customer base that needs a place to live today, and for that home to enjoy a lower cost of capital because it's on our platform. Just like that gold is more liquid because of the bullion bank, we think that home is more liquid because it's on our platform.
When we spoke earlier, Sean, tell me if I'm correct me if I'm wrong, but you're pretty robust in favor of and a little bit bullish on urban spaces, and a lot of your portfolio is in a lot of urban spaces. Is that true?
Yeah. So our SFR so we intentionally didn't dive off into build to rent. Yeah. Primarily because of the product and the locations. I just gave this speech to to my 25-year-olds who are trying to conquer the world in real estate. And, they brought me an underwriting, and it's a long story, but they underwrote these very fancy high-end, what we call cottages in Austin, Texas. So Austin is so land constrained in your town that you really got to maximize density. And so there are homes here that are 2-story homes that are 1,200 square feet, right? So these are 600 square foot floor plate homes. So they're very small homes, and they sell for a lot of money, which is a shocking high price. So our guys are going to develop one of these communities, and I look at it, and they had taken this cottage and they were going to put it on a piece of land that was way far away from any other cottage community, right? And so we're like, guys, like, rule number one in real estate isn't location, location, location. It's location and product, location and product, location and product. So you can have a really nice, dense product that people want because the location provides all the other things for them. Yeah. It's kind of like my daughter lives in an apartment in New York that is smaller than her bedroom at home, when she was in high school at home, right? However, the purpose of her housing is so limited, right? It's really just a master suite because the building has great amenities. She can walk to the coffee shop. She can walk to school. So like that product meets that location. With build to rent, we're concerned that the product doesn't meet the location, that the product itself is this highly dense thing focused on a very specific customer base. And that customer base probably needs the amenities of the city to fulfill the rest of their needs for their housing product. So I think that's why we're more excited about the urban core, is that we can lean on all of the rest of the community for the rest of the housing product. And then we can try to solve the house itself in a more efficient way.
Okay. So you were really attracted to those urban spaces. You saw them as just being sort of just safer. Is that fair?
Yeah, it's just more desirable. People want to live there. And I think that, but there's a lot of risks and barriers to this. So our single family, we look at our business, Dean, we use these terms internally that I think will be helpful for other people when they think about SFR.
Yeah.
So we have a scattered sites renovation business, right? And it's just what it sounds, right? So the homes don't need to be contiguous. They fit on our scattered sites property management plan. They fit on our scattered sites construction management platform. And we have a whole engine developed to buy, renovate, and operate one house, right? We also have a scattered sites new build capability.
Yeah.
So that's build one house. And it's really expensive for the market to build one house. If you go look at these deals where people sort of buy in like a gentrifying area and tear down a home and build a home, they're usually underwater after they finish, but it's a custom home where they want to live. Okay. And that's because traditional on-site construction technology is pretty inefficient to build just one home. It's pretty efficient to build 10 homes, the way a master plan community would be built or a production builder would build. They've gotten really good at like product and time and speed and materials and labor and so forth. But their whole ecosystem is build 6 foundations, build 6 frames, build 6 roofs. If you try to take that thing and disassemble it and say build 1 foundation, one frame, 1 roof, all the economics break down. So you've got this thing where the nation's new build capability needs big tracts of land. And those big tracts of land, right, are a tough commuting distance from current city amenities. Yeah. So that's why you have to build out some of those amenities. And so it becomes a very complex problem. So we think that like the urban core is a more difficult development environment, but a way more attractive one if you can solve the development issues.
Yeah, I mean, everybody loves walkability, but most suburbs aren't very walkable. And that's not something, it's very difficult, even on a master plan level, it's very difficult to build enough there to be walkable.
You have to play SimCity. You got to build everything.
You got to build that.
You got to build the thing to walk to.
Are you doing what we call conventional build to rent, that is multiple homes, multiple home neighborhood for rent?
So we've done a bunch of developments where we had separately entitled suburban communities where we would build and own the whole community and offer it for rental.
Yeah.
But when you drove through them, you wouldn't be able to distinguish them from another community because they're separately entitled homes on 50-foot lots with 1,500 square foot floor plates. They were just really a mass construction of what I would call typical homes, but we just happen to own them all and offer them as rent.
Okay. Let's switch gears to supply. I know you're very passionate about housing supply. I'm going to ask you a super simple question, Sean. What is your take on what do we need to do to increase housing supply in America? And we all know we need to.
Well, it's
Simple,
I mean,
easy.
If I could give you one sentence answer, we wouldn't have a supply problem. We'd fix it by now, right? Look, the supply issue has look. It's first of all, the supply issue isn't necessarily a macro issue, right? It's a micro issue. So if you look at a town like Atlanta, or if you look at a town like Dallas, or you look at a town like Austin, they have completely different problems with their supply side. So with Atlanta, they're pretty easy with zoning and they're pretty easy to do business with. And I mean, Atlanta and the suburbs.
Okay.
It's very hilly there. But the cost of labor in Atlanta is approaching the cost of labor in New York.
Yeah.
So they've had such a success in the product of Atlanta that they now have a difficult problem to build homes efficiently because the cost of labor is so high. Right, the cost of labor and the cost of materials. And the other thing, Dean, that we talk about is that, and we did a little study, there are more barrels of oil in a home than there are trees. So as energy prices stay high, it's very difficult to build homes efficiently. So you've got a different problem in different areas. The universal problem is that it's the consumer's buying power is not high enough to support the cost of construction.
Okay.
And you could argue that we could bring down the cost of construction or we could change the buying power, but we got to do one or the other and probably both. And it's very difficult to bring down the cost of construction.
Yeah.
And I'm sure you guys are the world's specialists in this, but you start trying to figure out how to carve margin, how to carve labor, how to carve material, how to carve transportation, how to carve the impact fees and whatever. You're not going to take 10 or 15% out of the price of a home. And so you might need to stretch how people buy. And the last time we tried to stretch how people buy, we almost blew up the whole Western world's economy. Right. So we think it's an intractable thing that will take time. It'll take time for the population pyramid to kind of run its course. It'll take time for the income, the buying power of the consumer to catch up. And it's one of these things that's going to be with us for a long time.
But you're from the mortgage background. Isn't there a way to enable folks to stretch their dollar specific to housing, because it's such an important part of our economy and just people's lives, that isn't stated income and balloon payments and stuff like that?
Yeah, I mean, I think one of the more simple things is we could bring back the interest-only loan. The success of a loan that was interest-only for a decade and then was fixed rate. So it wasn't a floating rate, but it was a fixed rate loan that you didn't have to pay the principal for the first 10 years. And then you paid the principal over the next 20 years. Yeah. The success rate of those loans was about the same as it was for 30-year fixed rate loans. So that helps a little bit, right? That can bring the payment down a little bit.
Okay.
The builders all have these buy down programs, which are almost magic, because they lower the rate about 2 or 2.5%.
Yeah.
So they lower the cost of capital by about $6,000 or $7,000 a year. But I'm not sure people get this joke, but because the mortgage that you qualify for requires your income to be about 3 times your mortgage payment, right? Well, to pay $700 more a month in mortgage payment because interest rates went up, it means you have to make $2,100 more a month in gross income. So the buy down really helps get that monthly payment down, and it helps a larger group of people qualify.
Yeah.
So that's helpful. But look, the wages in America are going to have to come up. Yeah. And that's our bet, is that the way you're going to create buying power is incomes are going to continue to rise.
Okay. So you see it. But you do see it from both sides. It's going to be increased incomes and stronger buying power, but also ways to continue to innovate and get prices down. Is that fair?
It's that's what needs to happen. But man, we don't have a brilliant set of ideas on the innovation side for a production builder.
I know.
Like, these guys have their costs on the screws. It's very difficult to come in below what they're doing. And we can tweak the impact fees. I think impact fees should be graduated, for example.
Yeah, okay.
It should be a progressive system. So if I want to go build a $2 million house, my impact fee should be more than if I want to build a $200,000 house. So there's some knobs that you can turn on that side. But I don't know if people have really sat down and done the math. It's worth them doing. From June of 2019. And it wasn't like we were saying June of 19 was the greatest affordability housing market in all time. It was okay, but not. There was a supply problem. There was an access problem in 2019. By that point, we were 9 years into SFR, right? From June of 2019 to today, the principal, interest, and taxes, insurance on the same house are up 80%,
Yeah.
80%. Incomes for the median family are up 17. So whatever affordability problem we had going into COVID has basically made the situation urgent. So you've got the young family that needs this product of the suburb, the school, the space, the access to all the things that young families need, has just been pushed completely out of the market since rates shot up and home prices shot up at the same time. So there's never been a greater need for high quality rental stock than there is today.
Exactly. Are there some other things that can happen? For instance, ADUs, as accessory dwelling units, have become kind of a hot topic. Do you see that as being truly helpful, or just sort of a modest impact?
We've done it. So we own a modular home factory, and that modular home factory is how we're going to try to develop way more efficiently in the urban core and replace all that derelict housing from the 50s and 60s. The ADUs are great for our factory. We're actually building one. So I have this fantastic nephew. My youngest sister has a son who's autistic, and he's an artist. And we're building him an ADU to put in her backyard out of our factory. And it's super cool. We don't see how it's going to create like substantially more housing for a couple of reasons. One is most of the cities that allow ADUs restrict the rental of the ADU to the primary owner of the home. So this would need to be like a national surge in people that want to become landlords and have a stranger living in their backyard. So what we really see happening in ADUs is people who already have housing getting more housing.
Okay.
They get that office, gym, cheese shed, whatever they call it. And it's really cool because it's highly accretive. It's you can build an ADU, a nice ADU in our factory and drop it behind a house, and it will appraise for probably 30, 40% more than your cost to do it. But we don't see it being like the panacea of solving like the access to housing issue.
I wonder if it could have more impact in the rental world, because you'd have, in other words, you can have two renters on that same space as you used to have one renter.
Almost no one allows that. For someone to rent the ADU, the owner of the home has to live in the primary home in most jurisdictions.
You know, I'll have to check that, but I think that's one of the ones that Governor Newsom has done. And in California, that is allowed. You can have multiple renters.
You broke it up,
I believe.
Well, now in Austin, they've kind of done this interesting thing where I think almost every city of Austin single family lot is now zoned for 3 homes.
Okay.
So you could take down one home and put 3 units in there, and they could be for rent or for sale. They're just not technically ADUs. So like densifying the urban core is going to be a big help to the housing issue. But you're into like a little bit of like redefining what housing is going to have to happen. Like does like the home, does the home need to look the same? There's a whole bunch of product development improvements that can happen, but not so much in like how do we build the same 3-bedroom, 2-bath house cheaper. It's like what has to happen, and we're spending time and money on this, and we haven't figured it out yet. But it's like if you zoom out and say, okay, what do people need, and what can they afford, and how do I make a product that fits that? And what you run into is you can do that. You can kind of figure out how to shrink the home, how to make it less expensive, how to densify the thing, make it a 4-family building or whatever. But then you'll find that zoning doesn't allow that product in most places.
One of the other things you're passionate about is offsite construction. And is that a way that we can start getting kind of twofold? We can get a little more supply through offsite construction if you can make things more timely and quicker and expedite things. But you can also bring down the cost, hopefully, by using offsite construction. I know there's some debate about whether that really does bring down the cost of the build, but
well, I think we can end the debate. I think so. We own a factory. We built hundreds of these things. So there's several things going on with modular construction that I'm excited about, and I think that I'm glad you let me talk about. So one is we did a big survey. Consumers struggle with the difference between a modularly built home and a mobile home.
Yeah.
I've lived in both. And there is a difference. There is a big difference. Okay. So, we have to explain to people, to local governments, to all kinds of people that modular is a construction technique.
Yeah.
A mobile home is a type of home, right?
Okay.
So that's a big barrier for the product, is the consumer acceptance. Yeah. The second thing is that the consumers believe it should be cheaper because it's built in the factory and it's not as good as the thing built on site, so it should be cheaper. And so you have this mismatch because in actuality, it is an I mean, I don't know every home built by every production builder, but it's certainly not less well built. I would argue it's, I've got licensed, US based, trained craftsmen in a factory that do my framing, that run my electrical, that run my plumbing, that lay my roof shingles. And we think they build a better product than the crews that build them on site. Okay. So you have this misnomer where the consumer thinks that they should get a discount on it because it was built off site. And actually it probably costs a little bit more to build it off site because it's a better home. I would say it's more of a craftsman's construction than just kind of slammed together. Now that people kind of get the joke once they're in one, and you can feel it. Right? You can feel it's tighter, it's quieter, those types of things. But that's a barrier to the industry because there's this misnomer out there. The other thing is that if you're going to go build, we're building a modular neighborhood or a home. We're building a neighborhood in just south of Austin. It's going to be 150 homes. We're building them for sale. We originally were going to build them for rent, but the market flipped and the valuations for rental versus for sale. So we're doing it for sale. We're building them all modular. There's 150 units. So there's no question of like champion, challenger, offsite, onsite. We just built 100 homes in Orlando with onsite construction, right? It's absolutely no cost advantage to build it modularly, not one penny. Okay. And so if anything, it might be a little bit more expensive. And it's a better home. Like it's like the corners are square, the insulation's thicker, blah, blah, blah. So I think that the reason we're in the business though is not to build neighborhoods in our factory. The reason we're in the modular home business is because of the scattered sites new build opportunity. So you remember when the Flint, Michigan thing was happening and those kids were getting lead in their water and whatever? That is a plague on the United States. And it's not just the lead pipes in Flint. Okay. It's the pipes inside of probably every home built prior to 1958 or 59. And they're still in production. Those homes have lead-based paint. They have aluminum wiring. They have iron pipes. And they have asbestos siding. And so to this day in America, if you want to operate a home that has all those things in it, you just have the resident sign a release saying that they were made aware and they move in. Okay. And you encapsulate the lead and you encapsulate the asbestos. Those homes need to come down. If you really want to see a real CapEx plan that creates the United States, it's the CapEx plan to take down that housing and replace it with better housing and provide those families with a way better product. That's what we think modular can do, and we think that might be the breakout for the business that the industry has been needing. Right, like its modular hasn't its market share is so low. You could just say it hasn't worked.
That's a great segue because I was just going to ask you about that. But how do we get to that critical mass? Because one way about offsite, like I say, we have to change the perception that it's a quote unquote cheaper home. It's not. But if you can get to the critical mass of offsite, could it actually then be also less expensive to build and solves part of that equation?
There's two issues that are in the way. So with enough volume, you should be able to, because just as you widen your production slope, you don't increase the top of the pyramid's cost structure. So there should be some efficiencies. And so maybe like our factory can build about 700 homes a year. And I'm sure at 700 homes, our cost might be 5 or 6% lower per home. Okay. But so much of the costs are tied to that direct asset that you don't have like a massive economy of scale. Okay. That's one issue. Another issue, and people don't talk about this, is that, so we built the home in modules. Maybe that's why it's called modular, right? And the module could be half a home, a quarter of a home, a third of a home, whatever you want it to be. But our version of modular is what they call volumetric. So we build like a big chunk of a house and we truck it to the site and we put the chunks of houses together, right? Well, when you build a home on site, you build the first floor, and your cost to build the first floor is X. Your cost to build the second floor is half of X, right? So the fourth bedroom in a 4-bedroom house is highly accretive because its additional cost is not the same price per square foot as the first bedroom, right? In volumetric modular, you don't have those economies of scales, because if I want to do a second floor, I have to make 2 more modules and I have to truck them out to the location and I have to build them in the factory. There's no economy of scale. So if I build a home that's 2 modules, or if I build a home that's 2 stories, my second story of on-site construction is going to be highly accretive to my build. because I'm already there. I already have the frame. I already have the people on site. Like I put up the second floor. If I do it with modules, I have to, the first two modules came out and built the first floor. To build the second floor, I got to go get two more modules from the factory. My cost for the second floor is the same as my cost for the first floor. So that is a real disadvantage to modular. It doesn't have that same accretive benefit for that additional space. And so this is why home builders want to build larger homes.
Yeah.
Is that all of their fixed costs of construction are amortized across more square footage. In modular, you don't get nearly that efficiency. So we think that for the industry to have a breakout is probably going to be where it has a real advantage is my cost to build one home in a really well located inner first ring suburb is about the same as my cost to build a home in a neighborhood in the exurbs.
Okay.
So we think that's probably, and the home's worth way more because of where it is.
Will it be residential though that makes modular building the norm, or at least much more accepted and much more part of the market? Or will it be maybe in apartments or something like that where that's...
Yeah, I think it might be. Multifamilies have huge success with it. And it's also, by the way, multifamily that's in hard to build locations.
Yeah.
Where you have noise constraints, garbage management constraints, hard time getting labor to the site. Because what's nice about modular is it's like my sister's ADU that we're building for her son. We don't have tradesmen traipsing across her home for the 6 or 8 months of the build.
Yeah.
We're in, we're out, and we're done because the framing, the plumbing, the electricity was all done in a factory somewhere.
Have you ever had any thoughts about 3D printed building? Because they effectively move that machine to the site.
Yeah, it's cool.
All on site.
It's cool looking. We didn't take it too seriously. We looked at it. And they're cool looking. I've gotten to tour one, and the insides are really neat. They're very architectural looking because of how the layers of the cement come in. So they're pretty cool. But when I stopped spending time on it, when I kind of couldn't get past this question of like the value build for the 3D printing piece, because we say we're 3D printing a home, we're really 3D printing a frame, right? Everything else is done the old-fashioned way, right? So the wiring, the plumbing, blah blah blah. There's no computers that are putting the faceplate on the socket, right?
Yet.
So there's so much of building is human labor of hanging cabinets and hanging sheetrock and whatever that like just the frame isn't very expensive and the sheetrock isn't very expensive. It's really all of those minute little details of countertops and cabinets and faucets. And so maybe if someone builds a robot that can do all that stuff, you can bring down the cost of construction. But on our factory, that stuff happens in an assembly line, so it's a little bit more efficient. But the 3D printing thing really didn't replace enough of the production process for us to feel like we should spend much more time on it.
Are there any regulations that you see? You have a lot of experience with policymakers and policy. Are there regulations that could help bring these costs down or make offsite more palatable?
Yeah, the bigger cities are onto it with the densification. Yeah. I think the one thing I do love about build to rent solves part of this problem is that right now, like in this neighborhood we're building in Lockhart, we're required to have the garage face the street. We're required to have the garage inside of the envelope of the home. That really reduces the amount of creativity you can have with your home. And then, by the way, that garage is an interesting concept. So we build a 1,600 square foot home, and I think the garage is 800 square feet, right? That doesn't count towards the square footage of the home. So there's an enormous amount of space in America in these garages.
That's a big garage, though. But most are 20 by 20 or so.
Was it 20 by 20 or 20? I think ours are 20 by 40 or something. So they're just, anyway, I may have gotten the math wrong, but it's a huge percentage of the build is this garage. And you're required to have it. It's required to be facing the street, which is very attractive.
Yeah.
And then it limits kind of the density of living space you can get on the ground floor. So I think as people think, well, what's cool about build to rent, if the consumers, and they seem to be accepting it, is that you park in a parking lot and you walk to your home. And it's slightly less convenient, I would understand. But man, does it make your site more efficient.
Yeah, we call those horizontal apartments effectively, where it's a true build to rent, but you're parking like an apartment. There are some costs to that. There's a security issue. And there was a kind of
in the rain, you got to get from your car to your house. But man, the neighborhoods are so cool. You can walk through your neighbor's yard, through the sidewalks. It starts to feel it's a pretty cool thing. But that really brings down your cost of construction because now you don't have to have a parking lot with every home.
Okay, let's talk a little bit about demographics of your clients? Who are the folks who live in your houses? You kind of characterize those folks.
Yeah, so it's the age spectrum is pretty broad. There's a little bit of a barbell of like young families and older folks. We're starting to see more of this sort of baby chaser phenomenon where people just want to simplify and rent, and they want something that's easier to manage. But if you think about the housing market, right? So the multifamily market is made up of kind of two populations. They're the ones that are sort of the small families that just need small space, and a lot of them are younger, and they tend to not have many kids. So like something like a fifth of apartment dwellers have kids, right? And then when you look at the homeowners, like twice as many of them have kids, like 40% of people who own homes have kids. If you look at our renters, about the same percentage of them have children. It's about it's about that 40% range of our residents have kids. So the homeowners make a little bit more money. So the homeowner family now, like first time home buyer qualifying income went to $120,000 from like $70,000. Our families are sort of just under $90,000 average income. So they're 2/3 of the income of a homeowner, same number of kids. That's the big general blend. Now, our customers are more single parents. So only less than 40% of our families are married, right? Our residents are married. So it's kind of what you would think, right? It's like that's the reason that the household makes less income is it's one earner instead of two, but they have just as many kids. So, the divorce rate in the United States is 50%. So you end up with a situation where a family needs all those amenities, as I talked about, the whole amenity, all the community, and they have less income. They end up in this, they end up renting. And so it's not really, it's not serving the same customer base that the multifamily market services.
But it's still a people who are, comparatively affluent families. I mean, good, normal neighbors. But you described earlier, a lot of cities have a little bit of a NIMBYism against rental and single family rental, but so do a lot of people, a lot of residents. What do you think is driving?
Rent's a 4-letter word, right?
For sure. So, what do you think is driving that antagonism toward the people you just described?
Yeah. So I have to go. I get to go and take the browbeating on the narrative. Right? People want to say that what we're doing is wrong and we're interrupting the American dream and we're buying the homes and preventing people from moving in. And usually when I can sit down with someone who has these views, it doesn't take long for them to sort of sit back and go, wait a minute. Because it's like, here are my families and here are their choices. And their choice isn't to go buy a house, right? Until you can. It's like our average customer has a FICO score below 700. The average homeowner has a score way above 700. So there's a big affordability difference here. The push against renters, I think, should be, and this is what I ask people to do, instead of taking it out on my families that live in my homes, because I grew up in rent homes. My parents had a family business. Gas prices tripled. It was a resort of sorts. Resort in a generous use of the term resort, right? It was more like the resorts in the show Ozark.
Okay.
But when gasoline prices tripled, our customers couldn't afford to drive the RV or the bass boat out to the resort, and so they had to sell the business at a loss and kind of go get real jobs. And that meant that the business's credit on they were sole proprietors of a business. They got a bad credit score. So they were American dream folks, like owning their own business, building their own business, got caught in an extreme economic cycle, and went back to Houston, Dallas, looking for work, and weren't going to qualify for a mortgage. So they simply shopped for housing based on where me and my youngest sister was still at home could get the best education, right? Yeah. And lucky for me, like that was their priority. Now, going to school as the kid that lived in the rent home was a thing, right? When people say, "Where do you live?" and you're like, "Over there," like, "Oh,
yeah,"
because there was a thing, right? There's a socioeconomic tiering that goes with being a renter, and it's a shame because the middle American is our customer, and if you're going to be biased against their socioeconomic position, you're going to have a lot of people to put your nose up against. But I think that in the end, when people say they don't want the rental next door or they don't want the renter next door, I don't think they're talking about the people that live there. I think they're talking about bad property managers. Like you're talking about. And what I try to tell them is blame me. Like if the trash is in the yard, if they park the car in the front yard, if they called the police 6 times, or if they're selling drugs out of the place, we've had all these stories, right? Then that's my fault, right? But don't blame the family that moves in because they can't get a mortgage or don't want to get a mortgage. And they want their kids to go to the same school that your kids want to go to, right? And I think there's a little bit of this, like, I don't know if you ever been on a airplane and the guy in the seat next to you paid 1/10 of the price you paid for your ticket. It's a little bit of like fairness issue. So there's a little bit of that. But I think primarily it's my fault as the property manager if the home isn't well kept and if somehow you think that home is affecting the value of your house. Or if I let a tenant in there, that's a criminal. And I can tell you, being a renter and being a criminal are two vastly different things.
But there is an element, I think you've kind of described it, or at least hinted at it. There is an element in, again, for lack of a better term, NIMBYism, that is the folks on the upper part of the socioeconomic scale are more likely to be in that camp. I think there's an economic element to that, not just a neighborhood element, I think.
Yeah, it's like, who do I want my neighbors to be? And do I want them to be my socioeconomic peers or not? Yeah. It's a little bit of the isms that we're trying to get over as a country of like, do I want the people that look like me to be my neighbors or not? But in the real world, what happens is we have 50,000 homes, so 50,000 storage, right? Is that we let a tenant in and didn't manage it, right? Okay. And something bad happened and they're mad at having a renter next door. So I think that we can do better on that front, but I think that this whole narrative that rental is bad is a little cruel because what's your other alternative for these families? Yeah. And they get hung up in this concept of like, well, private equity, Sean bought the house. It's a terrible thing, right? And they think about the family that could have bought the house. What I have to tell people is that, okay, guys, when that house came up for sale, there's not enough houses. There's not enough houses by a lot. So when the house comes up for sale, there's a bunch of families that want to move in. Some of those families, their parents will help them with the down payment. They have a high credit score. They're ready to go, right? And go get a Freddie Mac and Fannie Mae mortgage and buy the home and win the American dream. There's probably 6 or 7 other families for every one of those that says, geez, that's the best schools in town. There's low crime. 911 works. Domino's delivers, right? It's got enough bedrooms for my kids to all live in. And I really want to live there. And by the way, I make $10,000 a month. Right. But maybe I got a student loan I didn't understand. Maybe I got a medical claim I didn't understand. Maybe I got a credit card when I was 21 years old or 19 years old and I defaulted on it because I was immature of my financials, whatever. But I have a FICO score that doesn't allow me to buy and I want to live there. I help that family. I help that family live there just like someone helped my family live there. And usually when people sit back and I'm like, okay, so I got 50,000 of these families. Where do you want them to go? So if I sell all the houses to the other families, where do my people go? And there's no good answer. So I like to tell people is like they have these ideas for rent to own or shared appreciation or whatever the idea du jour is, right? Or they want to somehow make it cheaper to build homes or somehow cheaper to buy homes. And I'm like, that's all well and good, guys, but school starts tomorrow. Yeah. Right? And I got a solution that works today. So like, don't get in my way. If you have a better idea, put me out of business. But don't put me out of business because you don't have a better idea. You just don't, on the surface, like what I'm doing. And normally that conversation ends in them saying, okay.
Exactly, though. But that's that. You're going to have tens of millions of conversations, of these one-on-one conversations to get that to be meaningful in mass public opinion. Because there is.
It's hard. It's hard. And I do think that we're fighting I would say we're fighting the ethos of I don't want a renter in my neighborhood. Yeah. And that's this sort of subterranean thing. But look, there's 14 million rented homes in the country. We have, we get 5 people or 6 people touring every home that we have for lease.
Really? Okay.
There's an enormous amount of demand. And then today in 2025, you can also be sort of idealistic about how the housing market should work, right? But in 2025, you just took the cost of owning a home up 80% and income's up 17 in 5 years, right? So like whatever you're going to do to change the world, do it slowly. And for God's sakes, don't do it right now. Yeah. And I think that's what the regulators have finally started to hear. And then investors have started to figure out that owning these homes is a really durable cash flow that has a lot of positive attributes for your portfolio and its exposure to inflation. And you're doing a good thing. You're providing a much needed solution to a market that, like, we get hung up on like who owns the title. That's not what people are buying.
Yeah.
People are not sitting back with their portfolio allocation tools on do I buy or rent. They want to get their kids into the best schools, and they want their kids to be safe, and they have $2,000 a month to buy housing.
That is awesome. Let's end there, Sean, because that's a positive. I like that. Before you say something about 911 again and make me nervous that 911 is not going to work. You've mentioned it.
It doesn't work everywhere.
I'm getting scared now. I'm now worried about that. Sean, this has been pretty eye opening for me. I love that we started with your background too, because I only learned about that fairly recently from one of your colleagues, and it's a pretty fascinating story. So I'm glad we started with that.
Well, thank you so much, and I really appreciate you giving me a chance to share my story.
I appreciate you coming on. Thank you so much for listening. Listeners, this is Dean Worley with the New Home Insights podcast. We'll be back again in a couple of weeks.